Welcome to Venture Podcast, presented by VNTR, the world's leading investors community, the place to learn from VCs and capital allocators.
And the cool thing is that most people think emerging markets don't make money. It makes a lot of money. I mean, we're top 5% performing VC in the world because we're capturing growth. So by the end of this decade, emerging markets will be the majority of economic output in the world. So developed markets are growing like this. Emerging markets are growing like this. Emerging markets excluding China are growing like this. So if you can capture this growth by investing in technology that helps drive this economic development, 6-7% annual growth. There's a huge opportunity. We think it's one of the biggest opportunities in the world. So it's not like copy paste China to the world or India to the world. It's more like learn and then localize.
Hey guys, welcome to the NTR podcast. Today we are hosting William Bean Bao as a guest. He's a managing partner and general partner at Orbit Startups. So the VNTR, we are hosting top VCs and capital allocators to educate our audience around investments and funds. So welcome, William. Please introduce yourself, share some uh, some background about you.
Yeah, sure. So I'm William Bao Bean, managing general partner at Orbit Startups. We're an early stage venture capital firm focused on global emerging markets. We're early seed, so we're usually not the first check, but we're oftentimes the first VC. We invest. The key thing is we help with our lifetime support program, and then we follow on. So if you talk to entrepreneurs as often as we do, they generally want one thing, which is money. For early stage startups, debt is the worst type of money. Probably the second worst is investment, and the best is revenue. So while we do invest, we really focus on trying to help the portfolio companies that we work with, the founders that we work with, drive revenue. So thanks for having me.
Amazing. Thanks for joining. So you have quite interesting background. You started as a stock analyst and then moved to corporate VC and then VC. So can you share a little bit about your journey?
Yeah, sure. So I've been doing tech investment 28 years now. Long journey. And, I started off in equity research in Asia, then the US, then back to Asia. Funnily enough, remembering back to the early days of in the late 90s of equity research, it turns out I taught Michael Dell how to use his BlackBerry. So we were first 1,000 users. It was a Dell Analyst Day. I was a young associate, and he's like, my thumb hurts. I'm scrolling. I'm like, you gotta, if you want to scroll down paragraph by paragraph, hit the space bar. Been doing tech investment quite a long time. 11 years equity research. I switched over to venture capital in 2007. To basically lead investment in China and Southeast Asia for SoftBank. This was one of the early SoftBank funds, SoftBank China India, and I did China and Southeast Asia way before Vision Fund. We were writing $1, $2, $3 million checks early stage, but it was one of the first sort of pan-regional Asia funds to roll out. From there, went on to be one of the three founding managing directors for Singapore Telecom Singtel Innovate, which later went on to become top 10 corporate venture capital in the world. The idea there was to bring the learning from China and North Asia to Southeast Asia. So what can you bring from this like sort of super app type of model to help telcos? And Singtel had about 400 million mobile subscribers at the time across India, Indonesia, Thailand, Philippines, Australia, Singapore. And so we brought the model, we introduced the model. Unfortunately, the model wasn't rolled out. Bharti Airtel used to be number one, which is part of the Singtel group. Now, Reliance Jio, who actually uses the model, super app type of model, ecosystem model, has overtaken them and is now number one. That plus a huge amount of investment. From there, moved over to Orbit. I started off as a volunteer mentor back in 2010 and running Orbit full time from 2014, so 10 years now. And we started from a 3-person team running what is now the longest running accelerator program in an emerging market in the world, that we know of at least. We've come quite a way from that 3-person team. Now we're 38 full time and doing global emerging markets investment, excluding China. We still help our companies enter China, but we're not investing in China since 2018.
Wow, it's a lot to digest there. So you're working in kind of corporate VC. What like did you enjoy corporate VC? Like how because it kind of those two terms don't really go together in my mind, kind of thing. I don't know. Maybe I'm just being a bit silly there, but it doesn't
Yeah,
really
so I
seem to
think
go together.
Yeah, well, I think the thing that that people they've had bad experiences with corporate VCs, both within corporates where they lost money, where their founders taking money from corporate VCs, and there was not just the interests were misaligned, or you had corporate VCs that were going in too early, thinking that they could get innovation from the startup, but the startup was too early. So there's the right way to do corporate VC, and there's many wrong ways. So what we learned from our experience, 2007, 8, 9, 10 with SoftBank, we had two LPs, SoftBank and Cisco. So it was a bit of a mix. We had a returns mandate, but we had two LPs, and so the idea is how do you balance returns and also having that strategic impact? And then for Singtel Innovate, pure corporate VC, what really helped us was that it was set up independently from the corporate structure. I mean, the worst thing you can probably do with anything with the word venture in it is put it next to the CFO. CFOs are there to not venture; they're just there to preserve capital. Whereas venture capital is about taking risk in order to drive not like the quarter or the year, but 5, 6, 7 years down the line, right? And so one of the things that Singtel did correctly was to make their CVC independent of the corporate structure. So we had a board, but our board was made up of board members from the overall group board, and the CFO was not a member. For me, very happy to see them becoming top 10 CVC in the world. Now, the challenge for me is that I did my 4 years, but I don't really like working for free, and so I left after 4 years to what is now Orbit, because the focus for me is really on getting a piece of the action, profit share, carried interest.
If you look at from the perspective of startups, is it good to get funding from corporate VC, and at what stage,
Well,
from
I
their
think
perspective?
most corporate VCs have learned that it makes sense to do things at a later stage. So they're usually getting involved Series A or probably actually more like BC. Um, and so the startup is not, is a bit more mature. They got product market fit, they got traction, and they're in a better position to deal with the long sales cycles associated with a corporate relationship. Right now, for Orbit, we have a 10-person enterprise sales and partnership team on our team, and we help bridge the gap between earlier stage startups and our corporate partners. But for a kind of a corporate VC or a traditional corporate where they don't have that capability or that understanding, it's important to be a bit later stage as a startup that wants to engage. The second thing is, as I said, there's one or two right ways to do corporate venture. There's many wrong ways, and you want to understand whether your partner on the corporate side is doing things right or doing things wrong, right? So you don't want to get yourself in a position where you end up with death by corporate. And so the easiest thing to do is just do your research, right? Talk to companies that have worked with them before, try and understand what their objectives are and whether the corporate's objectives align with your objectives, and then understand time frame. Because for corporates, they work in their own time frame, which is oftentimes different than a startup time frame, where they're usually raising money for a year, year and a half at a time. So as long as there's alignment and mutually acceptable objectives, it can be a very, very fruitful arrangement. I wouldn't expect, as a founder, you should not expect the corporate to act like a normal VC, in that once they invest, they oftentimes don't follow on. So don't expect that. And you can have a very, very valuable relationship. Now, some corporate VCs really try and drive a commercial um, engagement in and around the investment, and some do not. So try and understand before you sign what kind of relationship the CVC has with the business units, and is it engagement before, is it engagement after, or is it engagement sometimes never? And that's quite important. And then the last thing is, uh, again, when you're asking companies that have previously been backed by the corporate venture capital group, just see, what their experience was, how the CVC interacted with the business units within the corporate, to get a sense of are these folks that have buy-in from business units, or are they more independent and less connected back into the business unit? Because there's a whole spectrum there of very close and very far away, and every single corporate is different. It's not a one size fits all.
That's great advice. And as a corporate VC, did you co-invest with other corporate VCs? Because we see different collaborations between the different corporate VCs. And how did you build relationships with others?
Yeah, so I think co-investment is the key. Most corporate VCs don't lead, although sometimes we led. We were a bit different because we acted like a traditional VC, even though we were a corporate VC. But there's definitely some collaboration there. Bundle deals with corporates as a founder, that's very difficult. So trying to tie an investment to a commercial engagement is hard enough. Trying to get three corporates to work together is like herding cats. So the general advice is don't try and bundle it up. There have been many sort of failed programs in the past where multiple corporates came together saying, hey, we're going to work together to do something. And those ended up being discontinued because it's very difficult to get three large lumbering organizations to agree on, what color the sky is, let alone on an investment.
Can imagine it's a very frustrating experience. Even working with one with the sales cycle of 6 to 18 months, and then having to get three of them to basically align on taking risk together, and they might be competitors maybe to some extent. That's another question actually. Do you ever see that kind of competitors, corporate VC kind of that kind of game ever, or is it more collaborative, maybe a little bit like the traditional VC?
I think it's more collaborative. Most large corporates, I mean, we were talking telco here. So for telcos, they have their own regions. So they're doing the same thing, but in different regions. So it's actually pretty easy. You generally don't get two telcos within one region investing in the same company. So from that standpoint, it's pretty clear, and so I wouldn't really worry too much about the competitive aspect there. But yeah, like look at the strategic angle of the corporate VC, see what you can get from it. And again, some like if you're talking about Southeast Asia, most of the corporates they want to invest first and have commercial engagement second. Okay, which is very different than most of the rest of the world, where it's commercial engagement first and only investment much later or second. Yeah, so you have to be cognizant of the region that you're dealing with because they have very, very different habits.
Mm.
You mentioned that the incentives of the corporate VC typically not aligned with ambitious managers. Did you see examples of corporate VCs that do share carry or kind of some economics incentives with
Yeah, I mean
managers?
there are some corporate VCs that do provide carry. Although what I've seen over time is sometimes those managers actually spin out into an independent, and then take outside LPs. So you saw that with, for example, Telstra, and some of the others. And then there's, oftentimes a rebranding. With SoftBank, they're pretty unique. What they did was had the backing. This is the early days, way before Vision, right? So they would back a VC, lend the name, lend the capital, and it would be, they'd take a part of the management company, take a cut of the carry. But then for the second fund, they would switch to more traditional LP, much smaller, less of an anchor or a smaller anchor, and then they would not take carry. And then over time, you would see the VC change their name and actually stop using the SoftBank name. So we had SoftBank Asia Infrastructure Fund, which then became Safe and is now rebranded to something else. Yeah, I don't know I forgot what they've rebranded to, but yeah, that's another way to you see this progression. Um, but again, most corporate VCs, their objective is oftentimes not to make money. It's to drive strategic position and understanding and market access and innovation access. There's a balance. For us at Singtel, to the outside world, back then, I don't know whether it's still the same, but this is quite a long time ago. We acted like a traditional VC to the outside, and we acted very much like a very strategic VC to the inside. And that ability to hold two conflicting ideas in one's head allowed us to hit that top 10 ranked CVC in the world ranking, because we served both of our clients, so to speak, and were successful on both sides, even though they had two different objectives.
And how does the corporate development team aligns with corporate VC? Like, is there some priority for the corporate to in M&A,
Yeah.
or I don't know, it's kind of are there some terms like this?
Yeah. So again, every single corporate is different. Sometimes the corporate development sits in the same department as the VC. Sometimes it's very different. Sometimes the corporate VCs are aligned with the corp dev. Sometimes they're not. Sometimes there's like an innovation department in there as well. I would say for the most part, corp dev is very different than CVC. They have different objectives, different sources of money, different everything.
Yeah,
So having corp dev together with CVC, seeing that happen is quite rare.
Mm.
cool.
So just taking a step back, you now work for Orbit. Um, so when did you start at Orbit? Just be great to understand kind of that part of the journey, going from corporate to more traditional VC, and how that's differed and how you're enjoying it, and any tips. That's what we're all after. We're all after tips to see how the pros do it.
Yeah, so I'd say we're anything but typical VC. If you look at most VCs, they invest in innovation. But for Orbit, we are actually trying to innovate how VC is done. My partner Oscar always says, like, you can't keep on doing the same thing expecting a different result, right? So we've continually been iterating our model, and we are very, very far from where we started. When I started full time as a decade ago. So Oscar and I started off in 2010 as volunteer mentors, and then I took over the running of what is now Orbit in 2014, and brought on Oscar full time from 2017. And basically, the we are a VC. But what we try and do is we try and add value on top of just the money, right? So we started off as a typical kind of 3 month accelerator program back in 2010. When I joined full time in 2014, started making changes. A couple of years later, made the program not just 3 months, but 6 months. And then a couple of years before COVID, I think 18, 19, we made the program lifetime support. And in the early days, it was pre-seed, trying to get the company from 0 to 1, product market fit, and then we slowly changed from 0 to 1 to 1 to 10. So early seed. Now we still very much focus on product market fit, but because we're helping companies that are in one country expand cross-border into other countries and helping them get sales, that experience in getting product market fit in a new country, and then another country, then another country, then another country, has really paid off. So today, what we're doing is we're taking our my 20 years of experience investing in China, 15 years in India, and bringing that to local founders in emerging markets around the world. So it's not like copy paste China to the world or India to the world. It's more like learn and then localize. So if you're looking at a challenge in a global emerging market, is it similar to a US challenge or more similar to a China or an India challenge? It's definitely much more similar to a China and India challenge. So you have a China India challenge, China India solutions. You take that to Nigeria, you take that to Indonesia, you take that to Bangladesh, and it's much more likely to get traction faster than if you're trying to copy paste something from Silicon Valley. It just simply does not match. So what we try and do is help our companies grow in their home market and then expand cross-border, Southeast Asia, then South Asia, then we went into the Middle East, North Africa, Sub-Saharan Africa, and as of a couple of years ago, LATAM. So all the global emerging markets, excluding China. Well, China's pretty developed at this point.
Can I ask, maybe this is an unfair question actually. Can
Yeah.
I ask which regional country you get most excited about when you talk about, launching in or maybe the next 20, 30 years?
Yeah, so we're pretty much in all the emerging markets at this point. So I get the most excited about I don't know whether you want to say the most traditional, least digitized, messiest markets. When I say messy, just like sometimes people have been doing things for 200, 300, 1,000 years in the same way. And that makes them ripe for technology-driven economic transformation. So we started exploring Pakistan in 2017, started investing at the end of 2019. And there's been like three odd devaluations, a giant flood that wiped out an entire year's worth of crop, turned the center of a country into like a 200-kilometer wide mud puddle. It's horrible. We had COVID, we had inflation, politics. And all 23 of our portfolio companies are still operating. There's nobody funding them really right now, so they're all break even or can go break even anytime. And they're growing because they are fundamentally changing the structure of the economy by digitizing it, making it much more efficient, reducing waste. I mean, we invest in a lot of companies that deal with food, and a third of the world's food is wasted because it rots in between the field and the market. So making that more efficient creates a lot more margin, not because we're cutting people out. I mean, we are cutting out middlemen, middle people, but just by reducing the amount of waste, the farmers make more money. The stores, the mom and pop shops are making more money, and like in Nigeria, we're lowering the cost of food in communities by 20%, so the consumers are a lot more happy. And when you go from spending 60% or 30% of your monthly income on food, and you reduce that by 20%, there's a lot more money to pay for things like education and smartphones to help people get a better job. So we're focused on like two main things: digitizing very traditional industries like farming, transport, supply chain, logistics, manufacturing. We're also investing in companies that help people make more money, help people have a better quality of life. And so when you have a 200 million population country, 200 plus million, we can have this huge effect of bringing people from below the poverty line to above the poverty line. Now, the most important thing for us is we do not want to do it the exact same way as China did it. We don't want to do it the same way as India did it, because if you look at China, 95% of the waterways were polluted. The air was a mess, is still a mess in the interior of the country. India, again, the air pollution is horrible, and 40% of the population has a lifestyle disease. So we need to create this economic transformation in a much more sustainable way. I mean, if you think about it, between now and 2080, we're going to have 2.1 billion more people in Nigeria, India, and Indonesia alone. Okay, so that's a and the entire world's going to obviously expand their population even more. What's the best way to drive sustainability in these emerging frontier markets? Is to digitize and help people have that better quality of life. So that's our main focus. And the cool thing is that most people think emerging markets don't make money. It makes a lot of money. I mean, we're top 5% performing VC in the world because we're capturing growth. So by the end of this decade, emerging markets will be the majority of economic output in the world. So developed markets are growing like this. Emerging markets are growing like this. Emerging markets excluding China are growing like this. So if you can capture this growth by investing in technology that helps drive this economic development, 6-7% annual growth, is a huge opportunity. We think it's one of the biggest opportunities in the world.
Yeah. So you mentioned that you help a lot. So for that you need not a typical team, right? So if you mentioned that you have quite a sizable team, so what is the structure of your team in order to support and provide lifetime support for your portfolio companies?
Yeah, so we have about 38 full time, and we're structured almost like a service provider. So yes, we invest. We take stock for our investment, but we also charge some common stock for our program. We're not super greedy about it. Our total ownership is usually between 5 and 8%, and that's based on the traction that a startup has before we invest. But the services that we provide, I mean, we want to support the founder getting from where they are to where they want to go, right? And so they're focused on building their business, and we do help them with that. But we want to help them take care of all the other stuff that we don't want our founders to have to get a PhD in like corporate finance in order to not get screwed by their Series C VC, right? So we want to be there with them side by side, helping them. Now, by the time they get through the process, they will have a PhD in it, but they're not going to have to do it all by themselves. We'll be there with them step by step. So we provide a service. We have a 10-person investment team. So that investment team does focus on doing new investments, but the vast majority of their time is serving as sort of like in-house bankers, financial advisors for our founders, right? Helping them raise money, understanding the term sheets, helping explain the legal documents, cap table sensitivities. We do this all for our companies as part of the service. And we do charge that common stock for it. We also have, like I said, a 10-person enterprise sales and partnership team. And this team is very important. If you're a startup founder, trying to sell into a large corporate is like spearfishing into a mud puddle. You end up not hitting anything, and you get a blunt tip at the end, right? So you're just you're smashing and just wasting a huge amount of time. So our team spends a lot of time constantly talking to our corporate partners. I mean, we're lightly engaged with 192 corporates and multinationals, but we're really heavily engaged with about 40 of them. But we just ask them, what do they need? What are they looking for? What are the challenges and opportunities? Because corporates don't have problems. So challenges and opportunities that they're looking out for. And when there's a match, we pull the startup in. So instead of startup pushing in, it's more pull, which makes things a lot faster, accelerates the long sales cycle associated with any kind of corporate sales. And then we do have a growth team helping our companies do data driven decision making. And then we have an ecosystem team. So we don't have alumni because it's a lifetime program, but we do encourage our companies to work with each other, right, and to help each other. And it's not just creating a chat board and a wiki where people can chat with each other. We're actually very intentional, and we have a team just focused on helping our companies partner and work with each other. You'd be very surprised, how difficult it is for a founder to sell to a corporate. Well, founders selling to other founders and trying to figure out how to work with each other is equally challenging when it comes to like communication, right? So we try and smooth that communication. And give you an example. We have one company in Thailand that works with restaurants to do a box. So at the end of the day, instead of the food going to waste, you put it in a box, you sell it for 80% off, and they're working with restaurants. We have another company in Hong Kong that's working with restaurants, and they have basically a software integrating all the different modes of communication that come into the restaurant for bookings with the restaurant reservation table tracking system. And we have a third company working with restaurants in Singapore and Malaysia and then Philippines as well, where they're enabling, corporate canteen food delivery. So like everybody can have like a Google style canteen service, but bulk delivery because corporates can't use Grab or Gojek or Uber Eats. The size of the orders are quite limited, and the accounting is a nightmare. So we got these three companies, different regions, all working with restaurants, and now they're helping each other go into each other's markets.
Nice.
And that's working extremely well. And so now you've got the Hong Kong companies into Singapore and into Thailand, the Thai companies in Hong Kong doing quite well, and then going to Singapore, and vice versa. So so that's what we're trying to do. Again, instead of having to raise a lot of money to hire a lot of people to get this effect, we try and help our companies on a double opt-in basis work with each other to lower that cost. That reduces dilution. So happy founder, happy VC.
And
That's
that's where
great.
I guess the magic of collaboration comes in, where two plus two equals five, right? And that's where
Yeah,
the and I think once you get that going, but again, as a founder, you've already got way too many things to do, right? So I guess the challenge is kind of seeing the benefit of investing that time in collaborating with someone else, which usually is quite low on the priority list.
yeah, I think it's quite low. But if you think about, the fact that most of these founders are investing huge amounts of their money, which is coming from VCs, so it's dilutive, into hiring people and acquiring users, or even on the consumer side, spending $1 on Google Ads only to make 50 cents. Pretty quickly, they understand the value of collaboration. But again, it's about matching. Startup to corporate. The startup needs to be a certain level to actually get something done with the corporate, and then startup to startup, there's always sometimes there's a timing mismatch. So we really try hard not to force people together. It's got to be the right timing for all parties involved. And so that's what we've learned over time.
Hmm, interesting.
Yeah. Yeah. But the result is that even during this rough funding period, like our companies don't really die as often as they used to. So everybody has power law, right? And we've got power law too. We've got superstars in every fund. But with this ecosystem approach, we're not just making money on one or two companies out of 10, we're making money on five or six. Because with the ecosystem approach, the middle of the group, you're always going to have the ones that are going to fail. And then you always have the ones that are going to super outperform. The key thing for us is we got this middle that gets boosted up. And the cool thing is that we want this ecosystem that we're building to be open to all of our VC partners. It's not just for us. This is especially for our early stage VC partners. We want to work together, and this is supposed to be once we get something working, we want it to be open to all our fellow VCs. I mean, we own 5 to 8% of each company. We never go above that. There's plenty of room for everybody else, plus the founder to still have a very large stake. And our goal is for Series B to be the last round, if possible. By that time, the company should be profitable and scaling. If Series B is the last round, that's great for the founders. It's great for our fellow VC investors. It's great for everybody.
That's great. If we step back to the team size, right? It's kind of it's a typical team size for a VC. How do you sustain the team? It's kind of if you don't
Okay.
charge anything from companies for services, right?
Well, we do.
Oh,
So
you do.
we came from a historical accelerator background, 2010. So if you think way back to how accelerators were run and funded in the old days, so we have a fund and we do invest 180K, but we keep 50K of it as service. So our
Mm,
fund company sends 130K to the company and 50K to our operating entity. Right. So that covers about half of our budget. And then the other half of our budget is sponsorships and grants.
mm,
Most funds of our size, like less than $100 million, 2% of that is almost nothing and mostly covers like the legal fees and maybe the
exactly.
general partner's salaries. Right. So our team of 38 full time is supported by those program fees, but it's actually heavily supported by grants and sponsorships. So the great thing is we don't have to really pay for offices anywhere around the world because we get them for free from our partners. So again, it's all about partnering and hopefully having a win-win-win. So we've been able to slowly grow our team over the last 10 years from 3 of us to 38
Nice.
based on this model. It's not a normal model, but
Yeah,
so far so good.
that's great. And do you collaborate with governments? Like, I think it's like being top VC in emerging markets, you should be, you know, working with governments. So how do you
Yeah, yeah.
utilize
No, we
these
we
relationships?
definitely work with governments. We've been helping building startup ecosystems from like China to India to I was even I used to work in Silicon Valley, 2001. So we do a lot of startup education programs for our government partners, those sponsorships and grants and offices from our government partners are very important to what we do.
Yeah,
It also, So I think for them it's a win-win. If you think about what governments want, they want a vibrant ecosystem. Of course, they want the unicorns that they can like wave the flag about, but they also want job creation. They want real businesses. So a traditional VC, when you pair it with the government, is not that great of a fit because the VCs are you're seeing like one or two big hits and then the other eight die, right?
yeah,
And that doesn't totally align up with the role of the government, which is to try and help like everybody. So we cannot help everybody, but because our survival rate, that middle sort of that middle bunch are doing better. It aligns much more closely with some of our government partners than a traditional VC might.
Mm.
that's great.
And speaking about that, like VC is not just about what you know, it's who you know as well, right? So I guess the question is, do you have some sort of strategy around networking or meeting people or anything like that? Like, is there a strategy to it, or is it kind of more art in your world? Given that you've had some success and you've had a lot of success, sorry, and you've invested in a lot of good companies and met a lot of good investors, etc.
Well, I guess one of the advantages is I'm really old. So, I've been doing tech investment 28 years. I hit the limit on LinkedIn about 8,000 people ago. And then apparently there's also a 25,000 person limit on Google contacts. Otherwise, it stops syncing, which is a real pain. And I made some mistakes early on testing software where
It
um,
merges. Yeah.
yeah, it all merges together and turns into a giant mess. So I actually spend way more time than I should on trying to clean my own databases and get people who have retired off of them, because 27 years, 28 years is a lot of people who are actually well retired since I've been in
Or
the
passed
industry.
away. Yeah, or passed away.
Well,
So.
hopefully not passed away. Yeah, there's a few, but like, no, hopefully not. So I'd say one of the things about early stage is you can't hide. So we try and make ourselves available in industry events through amazing, podcasts like this one. And the challenge of that is by being available, you end up getting a lot of inbound. So what we try and do is encourage people to, reach out to one of the 550 mentors that we have that they might know for a warm intro, or work with one of the many accelerators or government programs or angels or angel syndicates or VCs or micro VCs that we partner with. Um, and just get an intro to us. It's not to say that if you don't get a warm intro, if you just come in cold, we won't pay attention. But it just helps to jump the queue to get that warm intro. Our deal flow is by far mostly referral, and we partner with many groups all around the world because we're not really local anywhere. So we rely on our partners for local contacts, local intros. What we do is we bring our system, we bring our ecosystem, we bring our sales team and our relationships, and we partner with others who've got the feet on the street locally. We've invested in, I took Alibaba public, digitizing micro SMEs back from '05, '06, '07, right? So we've seen, 1,000 different ways to do this and 1,000 different ways to do it wrong. And we're bringing that experience to entrepreneurs all around the world who don't have it, and frankly, to investors who don't have it. But on the other side, they bring what they have. And so it's a great partnership. And we really rely on those partners and our 550 plus mentors to help drive the deal flow. We actually do not have a deal flow problem. We have quite the opposite. We just got way too much. So to some extent, I apologize in advance that sometimes it's a little hard to like break through. But yeah, it's sorry about that.
What tips I've been, well, I still am a founder, but what tips would you give founders reaching out to someone like yourself to kind of, because I imagine you get thousands, right? I mean, you're giving away money after all, like you're probably the most popular person in the world. But what tips would you give to entrepreneurs and founders who want to maybe get noticed and maybe want to have that first conversation with you or one of your colleagues?
Yeah, so I think there's three things. First one is investors overall. They don't invest in dots, they invest in lines. Okay. Um, so when you're reaching out, talk about traction and talk about traction over time. Um, so that's especially in Asia and other emerging markets. If you're in the U.S., they want to hear a story. We're not in the U.S. We're in global emerging markets where it's important to show that you've got traction of some sort. Okay. And for us, we understand the story. We understand the vision. We don't need to be sold like, unicorns and teddy bears or whatever. What we want to see is, the challenges that you're looking to solve, which we already believe in. Do you have something that's so far working a little bit in your country that we can help scale? Right. The second thing is again, just to repeat, warm intro better than cold, right? Cold's doable, but warm intro is better. And especially, just always remember that, you know, just because a VC doesn't respond doesn't mean usually it means they didn't see it. Okay. You get tons of messages. So just keep on following up. Um, and unless the VC says no thanks, we try and say no thank you, and if we can, why? But just keep on pestering a bit. Don't worry, it's usually it's because the VC did not see the message. It's not because they don't like you. And then I'd say the last thing is it's a very kind of like small world. So when you're going out, you're it's almost a little bit like dating, but even worse, right? So it's a long-term relationship, and there's a limited dating pool, right? So just be what you want to try and be is don't get discouraged, and you sort of want to be more on the friendly side. What I mean is that
Friend
it's
zone.
well, it's not so much friend zone. It's more like it's easier to get rid of your spouse than it is to get rid of your VC. Okay, because with a spouse, usually you have your assets, you cut them in half, and off you go. But if you want to get rid of your VC, you need to get another VC to come in and buy them out. And usually, when VCs come in, they want their money to go to the company, not to another VC who's going to take it and just leave. So you got to think, especially with the early stage VCs, is this somebody that you want to spend the next 10 years of your life with, right? Or something like that. And so there's the money side. But it's also like, is this somebody you really want to work with? Because it's a long, at least the way we look at it, it's a long-term partnership. And it's a lifetime support program. So, 3, 5, 7 years later, we're still working with the companies. I mean, we're still working with one of our companies. They're a unicorn. They're a multi-unicorn, and they're still in our program, right? And we're still working with them. So like weekly, bi-weekly, still we've got like a 7-person members of our team, a Tiger team, basically focus on helping support them, even though they're multi-unicorn and we invested back in 2015. So I'd say think that last thing is do your research, try and understand this through the meetings. Is something somebody you vibe with.
That's great. Could we discuss the challenges of fundraising for funds, or like what is your strategy, how to aggregate capital from capital allocators to keep the machine going and growing, right? So
Yeah.
we met each other in Silicon Valley, in Marrakesh, in different parts of the world. So you are everywhere, right? So you are also scouting for companies, but you're constantly raising funds, right? So what is your strategy for that?
Yeah, so I think the most important thing, and this applies to both founders and VCs, is you want to raise money from somebody who can actually give it to you, right? So you do your research, and you don't waste time chasing people where you're out of mandate, where you're out of their interest level, where you're out of their stage, right? And so
Mm,
for us, we're trying to raise money for our fund from people where we're in mandate, which for us is corporates, it's governments and governmental institutions, and it's a family office, high net worth, and to some extent foundations. Now we have great returns. We're according to Burgess early stage VC top 5% performing in the world, actually better than that, both in terms of cash returns as well as cash plus paper returns, DPI and TVPI. But we also understand that many of the folks that are investing in a fund like ours, sub 100 million, they have other things that they want and they need. So, for example, for our family office partners, we've got one in Switzerland, and they've done 13 direct investments after they invested in our fund. So they put 5x the money direct, no fees, no carry, versus the money in our fund. And we have like monthly calls with them, giving them an update on their existing portfolio within our portfolio, plus showing them new opportunities. So yes, they're in our fund. They're getting great returns, but they're also getting deal flow. We have other sort of family offices where they're basically a conglomerate that started investing, right? And so they're looking not just for direct investing opportunities or fund investing opportunities. They're also looking for innovation for their group. So we treat them like just like Unilever or AB InBev or Nestle or one of our other corporate partners. We try and figure out what they're looking for, what their needs are, and then we try and provide value both to them, but also by pulling in our startups where there's a fit. So we're helping them build a better business on their side, also helping them make money. By having a stake in those companies that they're partnering with. And oftentimes, they feel a lot more comfortable understanding early stage investing when there's a link between the business that they know and the startup that they're investing in. And then the third area is that, we're not an impact fund, but we're a fund that has impact. And there's a lot of interest in the fact that we're heavily focused on sustainability, on digital transformation, on, basically building up countries that have traditionally not had the resources, not had, the stability, just had, very difficult history, and they're very much invested in giving back to their country or giving to building countries that have been undeveloped or under resourced till now. And so while we're making money, we're also doing good. So the capital for good is the third reason why people invest with us and in us.
That's great.
And again, as a startup founder, this also can apply to you. So think about the persona of the investor that you're pitching and tailor the message to the audience.
Yeah.
Yeah, it's all about solving problems at the end of the day, right? And
Yeah.
that's, I think, a lot of people overcomplicate it. And if you haven't met someone that wants to solve a problem, then you will find someone else that does. Um, but I guess the next question is general partners, things like that. I mean, in your opinion, what makes a good kind of general partner for a fund? I know
Yeah.
it's a very
So,
broad question, but yeah, I just wanted to get
yeah,
your opinion
I
anyway.
mean, we're not a normal fund. So I have a belief in growing one's own, right? So, in our fund consortium, I'm the only general partner that had previous investment experience. Within our organization, um, all the senior team members have been with us, as mentors or from the start. And have rose up through the ranks, with the exception of one. And we do experiment, so we hired one person sort of in laterally, but that didn't have that context with us. But that's an experiment, and so far it's going quite well, actually. But generally, what we are focused on doing is making sure that there's a cultural fit, and also making sure that there's an attitude fit. And what I mean by attitude is, in the end, we are service providers. We're like mini co-founders. So the fact that we're bringing money doesn't give us status. In the end, our goal and our role is to serve. So we don't hire people with previous investment experience generally for our investment team, just because they often have to completely change their way of thinking, going from, okay, I'm the investor, I've got money, and I'm asking a bunch of questions, to flipping it around, saying, okay, I am the investor, I'm the service provider, and how can I help you? So sometimes it's just too great a mindset shift for people to make, especially early on in their career, where they haven't been there, they haven't done that, they haven't felt the pain, they haven't had to lay off their entire team, which I had to do one time. It's that context, right? So we tend to grow our own. And in terms of partners or general partners, I mean, basically what it comes down to is being able to identify and understand and then action upon challenges that our startups are having, right? Can you or can a person understand what's going on with the company, identify challenges, and then hopefully address those challenges or help the founders address those challenges and overcome? No, pretty much zero of our companies have the same business model, have the same product, or have the same approach to market after we invest than before we invest. So we help the companies make significant changes to their model, to their business, to how they do things through our lifetime support program. And it's really about rolling up the sleeves and getting in there and, sitting side by side. If they have the software, great, teaching them how to use it better. If they don't have the software, sitting there and helping them with a shared screen install the analytic software or install the tool, right? And then and help them go from like novice to an intermediate to expert to ninja in whatever the skills that they need to get to where they're going. So yeah, it's a very labor intensive approach to venture capital, and but so far it works, and for a certain type of person it's extremely rewarding because they get to see this like light bulb pop in almost all of our founders, where they're like, oh, this experiment, this approach, this iterative approach, it's basically just lean startup, but it actually works. Somebody who can really dig in and get into that, that's what makes a Orbit Startups partner a partner.
And you're one of the few that actually wear a startup T-shirt everywhere you go, right? It's kind of because it's
Yeah, well,
atypical for a VC to wear a T-shirt, right? It's kind of in a way
yeah, I
is
used to do investment banking, and I don't have suits anymore. Actually, I had to go to a wedding. I had to buy a suit, but it's a black suit, so I can either be in a t-shirt or I can look like a waiter. But yeah, no, I think we had to do a rebranding, and because of that, I'm like a walking billboard. I got five of these, one for every day of the week.
yeah.
Uh,
I
so
had
uh,
times like that as a startup. Yeah,
Yeah, yeah. Well, always be selling, always be representing. In the end, the thing about early stage, I mentioned it before, but you cannot hide, right?
right.
So, we gotta stand behind who we are and what we do. And if that means wearing a t-shirt, I know I did buy a jacket because of the fundraising. Some places they kind of require you to wear a jacket, so now I own a sport jacket.
Nice.
Yeah, my 11 years in banking kind of cured me of the concept of suit.
So last question about your life work balance, right? It's kind of you travel a lot. I don't know how much you travel, but how do you like? What is your routine, or kind of how do you keep yourself healthy when you travel, work so much? Kind of you probably speak every day for 10, 12 hours, like myself. But what do you do to keep yourself healthy?
Yeah, so I think for the last 2 years, I've been traveling 10 months out of the year, generally a different city every week. So I've been home, about 4 months and a week since August of 2022. Um, Now I'm home now because I ran out of passport pages. And if you don't have three empty pages, most of the countries won't let you in. So I am purposely grounded in America. I can fly around in America, but we don't invest in America. So
Yeah.
and it's August, and most of America is on vacation right now. I'd say there's three things. One is and I'm failing at this miserably, but sleep is a weapon, right? So I don't necessarily. I mean, I have an alarm to wake up, but I also have an alarm to go to sleep. So I'm trying to do my best to get as much sleep as possible. Like 4.5 hours of sleep is not like very productive, and sometimes I'm stuck getting that because I'm working 3 or 4 time zones. So the first advice, and this is why I wear this little wristband, it just basically tells me to sleep more. Um, and I pay a lot of money to ignore this wristband. The second thing is, have something that you do that's not work. So family, do my best. Although traveling a lot, sometimes my family comes with me. So we're empty nest now. So kids are all over the place, and so we just meet up in various places around the world, which is fun. And the other thing that I do is, for the last 2 years, I've been carrying a kitchen around in my luggage. So I managed to make it into this little a small bag that fits inside my luggage. But I've discovered a South Korean dual voltage induction burner. So it's a little kind of lightweight hot plate and a couple of camp cook pots. Got a little cutting board, cutting knife, and a little spice kit. And so on weekends when I'm traveling, I oftentimes cook.
Mm.
Not so much to save money, although it does save money. It's more like stress relief because if you're cutting up a bunch of onions and you start thinking about your startup, you end up cutting the end of your finger off. Yeah. So the idea is like do something else that's not work is important. Try and get some exercise once or twice a week. That's actually pretty tough. And then the last thing is, I just eat less. So kind of be aware of what you're eating. Usually, when you're in these conferences or these events, they've got giant, especially in the Middle East, got these giant mounds of sweets that I never, ever, ever eat. So just have to be mindful of your diet because for traveling 10 months out of the year, the uh, the normal is travel, not the normal is staying at home.
Yeah.
So I actually end up gaining weight when I'm at home because I have a proper kitchen at home. But the 10 months out of the year, just be mindful of diet. So yeah, just sleep, food, exercise, and then family, and then we got work. And that's about it. I mean, one of the things about Orbit is we have 550 mentors, many of which are my friends, and we do about 40 plus events around the world. So we try to combine the sort of the friend thing with the event thing with the mentor thing.
It keeps you
And that kind of
busy.
works
Yeah.
out. I don't have that much time for friends though, but we do have these events, and try and recruit most of my friends to become mentors so that they can come to the
Spend more
happy
time
hours
together.
events and hang out. Yeah, exactly, exactly.
Nice.
That's
Amazing.
a really nice narrative because I think there's a narrative at the moment. Hustle, hustle, hustle. Be productive, do as much as you can. But I think that just leads to burnout, right? And then when you're burnt out, you're making silly mistakes. You're annoying investors. You kind of go backwards, right? So I think what you're saying is amazing.
Yeah. Well, I'm saying it. I still need to make sure I'm doing it, because
Comply to
these
his
are the things that I'm trying to be self-aware. These are things I should do. But like everything else, it's a work in progress, right? So, sleep is I'm somewhat failing at. But I just noticed like you make bad decisions. You're grumpy. You're just not fully productive without everybody's got a certain level, but for me, over 6 hours is kind of the target. Because on 4.5, it's a lot less productive, and you end up making again those silly mistakes, or you just end up being like grumpy all the time, and that makes it very difficult for your team to work with you.
Great. William, thank you so much for joining us. Join us in Lisbon on November 13. We're hosting VNTR Summit. So
Yeah,
hopefully you're going to
looking
make
forward
it.
to it.
It's
Yeah,
during Web Summit. And yeah, and see you soon in one of the events.
yeah.
We are also
So
traveling.
yeah,
Yeah.
Yuri, Nico, thank you so much for having me. Great to share about Orbit startups, and very happy to be guest number 11 on
Thank
your
you.
amazing show.
Thank you so much.
Thank you.
Um,
Thanks for your time.